On our panel today discussing M&A activities in CE region. Teresa Scheffel she's investment director out of Munich with CNOC Fund. I'd like Teresa to introduce herself.
Sure. Teresa Scheffel, director in the European investment team of Sinocif Capital. Sinocif is a private equity buyout fund which was founded about 3 years ago along the One Belt, One Road initiative. And it's focusing primarily on the CE region, the 16 CE countries, and also Greece, which recently was added to the now 17+1 initiative. We do deals in terms of investment strategy in minorities, majority, but also have the flexibility to look into mezzanine opportunities. Our sweet spot in terms of size or deals are really in the mid-cap space, and we can write checks up to 500 million per single ticket. But when we see a real angle for us, can go even lower in terms of deal size and look into smaller opportunities. In terms of sectors, we have a quite broad mandate. We focus on advanced manufacturing, as we call it, consumer services, but also infrastructure, healthcare, and renewables are two sectors where we spent a lot of time looking into potential transactions in the CE region. And renewables was actually the sector where we did our first deal. In fact, during Corona times was a settlement of our first Polish transaction where we acquired the rights for 52 megawatt solar panels in Poland, which we're currently building. We initially focused more on Poland and Czech Republic, but now spending quite a lot of time in the Southern Eastern Europe region. So happy to be part of this panel today.
Thank you. William Faulkner Corbett is investment director from CE Equity Partners. William, please.
So we are the investment advisor to two funds. Our first fund started investing in 2014 and is now closed to new investments. And so we invested about $430 million. When we include add-ons, I think we did 18 deals in total in about 4 years. Our second fund closed 18 months ago, and that is $800 million. And we have only done 3 deals so far. So we have quite a bit of dry powder left in that fund. Our geography is the same as Teresa. There's 16 countries plus now Greece. In terms of sectors, infrastructure, specialist manufacturing, tourism, and agriculture are our main areas of interest. In terms of deal size, our minimum probably about 20 million euros, and we can go up to 90 million euros. We both take minority or majority positions, buyouts or development capital. I personally cover the south of the region, so I cover everything south of Poland except for Hungary.
Thank you, Bill. And Dragos he's now in Bratislava from Morphosis Capital. He's a partner CFO of the firm. Dragos, please.
Hi, I am physically in Bratislava, but Morphosis Capital is a fund focused primarily on Romania and specifically on Romanian small and medium enterprises. So we're a small cap fund. Growth capital, looking for significant minority or majority positions, but with a view of partnering with the founders of the SMEs and helping the companies grow their footprint nationally and regionally. So we are looking at bringing companies that are performing well and have shown growth at a national level to an international stage. Ticket size is much smaller than the one of my colleagues. We're looking at 5 to 10 million euros per deal. With, as I said, we are looking at SMEs. So we're a bit different, but I think it's going to make for a good diversity in this panel. We are a first-time fund. We have closed 3 transactions so far. Actually, we have signed 3. We have closed 2. We are closing the third one. And as either luck or opportunity would have it, 2 of them have been signed during this crisis of coronavirus. So I would like to share with you later during the panel some of our insights of what we saw differently and how we managed things.
Thank you, Dragos.
So back to you, Brian.
Our first topic is on what is the current state and the changes in the market practice. I think looking at the beginning of 2020, people, I think the thing that describes best the current situation is the saying then, which goes, if you want to make the God to laugh, you have to tell him about your plans. Everything's been a roller coaster this year. We have, in light of COVID crisis, we have a significant drop in the M&A activity globally, about 53% down. Q3 was even worse, with 3/4 of deals being lower compared to last year. Europe is only 30% down, but again on the for the first half of the year. But second quarter, again, is only 1/3 what it used to be. Despite that, according to the Mazars interview survey of private equity professionals, it turned out that 74% of investors are still looking for new investment opportunities in the coming months, and all of them are not shy from any lockdowns. So, Bill, what is the current status and what are the changes in the market practice brought by COVID you see in our region?
Yeah, I suppose, you know, if we go back to March, I mean, our initial reaction to COVID was to pay attention to our portfolio companies, to make sure, you know, all the classic things like cash flow, protect that as much as is possible. And so we spent probably about 2 months with a focus on our portfolio. I mean, I'm glad to say we haven't had any crises coming out of that. We've now, after that 2-month period, I think we came to the same view as that 74% in the survey you mentioned. We believe deals are possible, but they are definitely challenging. And so we haven't yet closed a deal during the COVID time, but I think we're expecting to have one closed before Christmas. We have others at the due diligence stage. So I have one that's within the region, and I think that's a good example of how slow things have become. I mean, this is a deal we first started talking to the owner in about this time last year, and we are now just starting the external due diligence. And I think, given, you know, our sort of normal pace and the owner being a sensible, well-prepared owner, in normal times we would have been at the stage of finalizing the SPA by now, we would hope. We've also started thinking, you know, our first fund, as I said, started investing in 2014. Again, the Mazars report you were quoting from, it says in there 74% of PE have decided to delay their exits. We made the decision not to do that, and so we're now starting to take some action on trying to exit our Fund 1 portfolio. In terms of, what it actually means for people working in the industry, I mean, clearly much less meeting, much less traveling. I mean, I have been working from home in the UK since March, and I have had 3 visits to the region. We're finding that Zoom calls are almost becoming the standard way of doing business. And so, for example, I had one visit for a couple of days to Greece. I thought I had 3 meetings, and 2 of them, having gone all the way to Athens, turned out to be Zoom calls, which was a touch frustrating. So yeah, I mean, that's how we see it.
What are the trends, Teresa, you see emerging from this crisis?
Yeah, the trends emerging from this crisis. I mean, I also have a little bit of how to say it, view also on what's happening in Western Europe, because even though CEE is our focus region, we obviously sit in Munich and have a little bit of overview of what's happening with in the Western European world. I think one trend that is really emerging is, but we haven't seen yet the results of it, is a lot of corporates actually and companies realized during the lockdown in the first month that supply chains from China are actually quite difficult and can be basically put on hold. So I think the region in the mid to long term is going to, especially Southern Eastern Europe, is going to benefit from that, because more and more companies are actually thinking of moving production from China to the Southern Eastern region. That's clearly one trend. If we speak a little bit about bigger trends, obviously in terms of sectors, clear trend was the changing consumer habits of the Southern Eastern European population, actually not only in Southern Eastern Europe, in the entire Europe, which made industries like e-commerce absolutely attractive. Now, such sectors have always been also on our radar as well. But they're becoming more and more difficult when it comes to valuation, as Bill said in the beginning. So changing consumer patterns is clearly one trend. What I wanted to add also on to Bill's comment on how the situation overall changed is, I think it's getting quite difficult to do deals for cross-border funds like that, where you really need to travel over and from China potentially, where senior decision makers are sitting and to seal the deal in the end. So this has been a bit of a challenge, but actually in the past few weeks we're seeing this a bit improving.
What do you see Dragoș being on the ground in Romania, actively looking for deals and talking with entrepreneurs? What are the trends from your side post-COVID crisis?
There are a few things that we have noticed during this period. One is that, as both of my colleagues were saying, that there's questions around valuation. Whereas before, in a growth period or in a more predictable period, you had anchors for basing your valuation. You had transactions, comparable transactions. You had ways of putting easier a value to a business. This has become a lot more difficult. There are ways how to address it, but the discussions on valuation have been taking a lot more time than they used to. Then there is, I can see from the people we talk to in the industry, the funds still want to invest. Nobody seemed to be waiting to see what's going to happen. Everybody wants to invest, but everybody is having a reasonable amount of cautiousness around sectors and around particular deals. The sellers, and here I'm talking mainly about founder-led companies, are having a very different perception of risk compared to a professional investor. The operational people are seeing it as something that is going to go away very quickly and painlessly, and this difference in perceptions of risk is what is leading eventually to different valuations for the company. So a lot of time is spent and a lot of energy is put into discussing technically, or not technically, negotiating, let's call it negotiating in the end, and aligning on what a common future and a common growth path could be. From the point of view of meeting people, one of the transactions that we have closed, I personally haven't yet met the founder. One of my partners did meet with him a couple of times, but I haven't, even though I was directly involved in the deal, everything was on Zoom. It's strange, but it's doable. And as trends in the sectors, digitalization is what everybody is talking about. Supply chains for sure, shortening them, making everything more accessible. But digitalization is the new mantra for a lot of companies, and being focused in a region that has been lagging behind the Western Europe in digitalizing its processes. There's a lot of catching up to do, and everybody is very keen on catching up and on having their business as efficient as possible through the use of anything from offering employees remote access, the most basic things, but a lot of people were struggling in the beginning to do that, to employing RPA and AI into making their business more efficient. So this is what I have seen in the last couple of months happen in the market.
Yeah, thank you, Dragos. Definitely, due diligence has become a big challenge. I don't think not being allowed to meet the owner or not being allowed to go into the factory and see the factory really helps when you conduct your due diligence, and especially in the operations. But unfortunately, that's a new reality we have to adapt to. In terms of the sectors and golden recipes, finding a good deal for in the region, what are you looking at? What sectors you prefer to invest and pay close attention to, and which sectors you would avoid given the current circumstances? Bill?
So we have these specific sectors that we are targeted at from the beginning, and we haven't really knocked any out because of COVID. I think, renewables are one of our focuses, and we're always keen on renewables. But for example, tourism is something that clearly is hit by COVID, but we're still looking at one tourist type because in the medium term, we believe this will all come back again, and perhaps it's an advantage to get a slightly better valuation. Infrastructure, specialist manufacturing, tourism, and agriculture continues to be our focus.
Teresa, have you seen any change in your sector preference due to this? Have you had to change the investment strategy and policy towards the different sectors?
Not really, actually. I think historically we've always focused on sectors which are relatively, I would say, crisis resistant and quite stable, such as healthcare. Healthcare has been clearly one of the sectors we've spent most time on, but also indeed infrastructure with focus on renewables, which are sectors which in our views are not really impacted. E-commerce, as I said, this has always been a part of our investment focus areas. It's getting currently quite difficult because one needs to take a view on what's the sustainable level of the EBITDA these companies are going to generate in the years to come, to what extent the changing patterns are really sustainable. In terms of industries which we have shied away from, I don't think that COVID has changed as much. I mean, these are usually cyclical industrial businesses, rather low margin, which now in Corona are getting more and more difficult, to be honest. I think one topic which has become in COVID even more relevant is the whole sustainability topic. So we will increasingly spend more time on looking into such assets, renewables clearly being one subtopic of that sustainability topic. I think it's actually a good time for companies which have funds to go out and do bolt-ons and even in sectors like tourism, which by the way are also part of our investment focus. The winners and the leaders in certain subsectors will have the chance, I think, to consolidate the market.
Yeah, great. Thank you. When it comes to valuation, Dragos, you mentioned you've been doing 2 deals this year and engaged a lot in valuation discussions. How do you manage the disconnect between the real economy and real performance of the companies versus financial indexes and market prices when multiples have expanded? How do you manage the valuation expectations on that when you close a deal?
Yeah, it's been a learning process, honestly. What we have discovered as the first hurdle was, what is the base of valuation for this business? Is it 2010 year to date and annualized for the full year? Would we take a couple of months from 2020 and exclude the others and annualize just what we would consider a base? Is it 2019? Is it a fair base evaluation? What is a multiple? We have history of transaction and comparable transaction, but for, let's call it, normal times. We don't have that much of a history for special times. So, and then
I think we lost Dragos.
Yeah.
On its most important point. Let's wait. He's back. Dragos,
hello?
you're back. You are back.
Is everybody still hearing me?
Yeah, we lost on the most important point.
Okay. All right. So we've been struggling with finding a base and finding comparable multiples. Then, if you go away from multiple-based valuation and you look into maybe a DCF, you're struggling with that as well, because you have very little visibility or confidence bands in which to base future performance of the economy, and then of the sectors, and then of the particular company. So what we ended up doing was to take a common view, as much common view as possible with the seller. All of our deals are partnerships. So the seller stays with the company usually in a CEO position or a leading position, and we are looking to maximize the common value at the exit. So we are a bit lucky from this point of view, because we do have the engagement of the seller for the period up until our exit. So we have tried to model or to put all of our concerns together, and from there to find a middle way. And the way we have managed to close deals was by agreeing on downside sharing and upside sharing with the founders. We have defined some schemes where below a certain IRR at exit, we are sharing the risk and the downside in certain ways between us, which is reflecting, let's say, our risk protection approach, but also to take into consideration a founder's or a seller's view that everything is going to be rosy and there are no risks. We have put upside sharing, where disproportionately a seller would take much more of an upside, and through this everybody feels that if things go their feared or their desired ways, they are winning out of this deal, and it was the way in which we could progress and sign. But it's been unwalked path, and we have been finding our ways with different owners differently. We have only stuck to deals where most of the consideration was paid as capital increase in the company. We have actually walked away from one deal in March, April, where the seller was insisting on having most of the price paid as cash out, and we thought this wasn't the time or the economical situation where it makes sense to reward an owner and not to insist on having the dry powder in the company to withstand any shocks that come its way.
Yeah. Thank you, Dragos. Bill, do you have any of your experiences with bridging valuation gaps this year?
Yeah, I mean, I think there's a lot of common ground in what Dragos has said. We tend to be more cash out than cash in, but we do cash in deals. But on the upside sharing, for definite, that is proving a mechanism that bridges some of these gaps, and that's the deal I mentioned that I'm doing at the moment, where we've just started due diligence. I mean, the only way the way we clinched that was upside sharing. The other, I mean, the only other point I've got to throw into the mix is IFRS 16. And of course, you know, this sort of changes the way of looking at the numbers. All our data is based, all our data on multiples is based on pre-IFRS 16. We haven't really worked out the impact. It's you know, one or two cases it's proving to be an issue, but we can't offer a solution.
Yeah. Speaking about regulatory environment, Teresa, do you see any new tax and legal measures which are impinging the M&A activities, especially you've been dealing with this year?
Yeah, I think, yes, there was indeed, after the Corona outbreak, there was a certain, I wouldn't say a panic that China is going to come over and take over a lot of targets in Europe, which triggered actually increased regulatory scrutiny towards non-European investments, and in particular Chinese investments. We've seen that especially in Poland, where there are now certain additional approvals required for non-OECD members, which I think is specifically targeting China. And the EU has also issued a white paper which elaborates on the Chinese interest in strategic assets, even though there hasn't been anything specific around it. It's currently just an idea. I mean, me being on the other side, I can say that I don't see that threat at all, because it actually hinders the processes. And I haven't seen Chinese buyers now being super active and trying to make more deals than they did before. It's actually not making things easier the pandemic is not making things easier for cross-border funds. So yeah, that's indeed something we've observed, but I think the Southern Eastern European region is still quite unchanged in that respect.
Okay, great. In terms of corporate and corporations, one of the latest PwC survey on the CFOs basically shows that about 60% of the CFOs, of global CFOs, are concerned of the global downturn, and about the same amount of CFOs are concerned on the new wave of infection. Half of them have been clearly indicating that their companies, their corporations have suffered financial impact, and more than half of them have revenues dropping more than 25%. Clearly, that will lead to engagement in different strategies, defensive strategies to salvage value and to safeguard their competitive position, while other corporations will be engaging in offensive strategies to gain market share, acquire competitors, and transform their business. How do you see the corporations playing in the region? What the impact they bring to the M&A environment and landscape, as well as the opportunities for you either to exit or to acquire? Bill?
Yeah, as you suggest, the main place we come across, main scenario we come across these big corporates is as buyers, possible buyers of our assets. They are, I was going to say notoriously, but that's not quite the right word. But their reputation is always not that they're not the fastest in this world, and I think the current crisis has just accentuated that even more. So we have one who's been showing an interest in one of our Fund 1 companies, and every 2 months we have a phone call, and they tell us, well, they should be able to do something in 2 months' time. So the interest is still there, but it is very slow. In terms of spinning off assets, which are an opportunity for us to buy something, I suppose we look at about 2 opportunities a year that come under that category. We haven't seen that number going up. We haven't seen any great rush to spin off.
Okay. Yeah. Okay, Teresa, have you encountered any corporate activities that will provide you a pipeline for opportunities to invest?
Yes, as I said, I think for the leaders in certain sectors, the crisis can also be an opportunity to consolidate the market. We have indeed have increased number of discussions on minority situations where corporates might need some fresh capital to actually continue their growth endeavors. Even during Corona times, because smaller assets are really the ones that will be more hit by the crisis than the leaders in each and every sector. So I see the crisis potentially as an opportunity for some of the corporates, and actually we've seen quite a few private equity exits during Corona times to corporates. I think the hindrances in doing due diligence, especially going and seeing the facilities and doing site visits, is partially an advantage for some of the corporate buyers because they know their sector very well and they don't need to have extensive commercial due diligence and extensive site visits, but most of the time they're familiar actually with the assets in the industry. Yeah. So in certain situations, actually, we've seen them benefiting from the crisis. Yeah. And for us, respectively, as someone who's investing in growing successful companies in CEE, an opportunity.
Yeah. Thank you. Dragos, you mentioned before a significant emphasis on digitalization. Do you see that push from corporations to acquire maybe some of the niche players that will add on the infrastructure and the digital infrastructure?
I haven't. I'm seeing quite a lot of corporations looking for the best solutions to address their pain points. And I think now maybe more than before, companies are looking for the best in class to address these pain points rather than acquiring it or develop it in-house. there is a frantic pace at which digitalization efforts are happening in companies, and I really think that the IT directors or the CIOs are looking for something that is off the shelf, easy to implement, easy to integrate into the processes, and just move to the next project, because a lot of them have almost overnight seen their pipeline of projects exploding, whereas probably before they had a pipeline well defined for the next 3 years. Now probably a lot of it has collapsed into a couple of months of implementation. So we see definitely an effort towards digitalization, but less in M&A. What we see is IT companies and automation companies and business process companies looking for targets to be able to offer a more complete product and services offering to their own clients, and to gain in what is now, as I perceive it at least, a quite fierce battle for new markets and new services.
Great. Yeah. If there are any questions from the audience, I think there is a chat room, but I don't see anyone. So with this, probably I have to thank you, the participants, and fellow panelists. Appreciate for your thoughts and for ideas, and hope that was quite useful for our audience. I'd like to thank you once again for attending this event, and looking forward to hear more interesting ideas from this conference.